Silver premiums remain high. The price has calmed down. Gold and silver haven't moved much in the last 2-3 weeks, but we're getting ready for the next leg up. Exactly when, I can't tell you, but it's going to happen. But the real leg up won't happen until after the final financial crisis, which we are getting closer and closer to. I am watching the percentage of bank reserves taken up by repos that will tell me when we have run out of dollars in the sewage system, in the monetary sewage system, and then we should begin the final round of printing.
Silver prices rose in American trade on Friday, on track for the second profit in a row. Moving away from 6-week lows as the dollar lost ground, the white metal is heading for the largest quarterly profit since 2022, on strong retail demand and the global cycle of policy easing. Renowned financial analyst Rafi Farber believes that the impending financial crisis will significantly surge precious metals once bank reserves are depleted. In his analysis, Rafi Farber highlights that the Chicago PMI has been below 50 for 21 consecutive months, marking the longest contraction period in its history. He suggests that this prolonged contraction could again lead to a substantial rise in precious metals. The price of silver may regain its ground as the recent U.S. inflation data raised the expectations of the Federal Reserve, reducing interest rates in 2024. Lower interest rates could spark the demand of non-yielding assets like silver. Regarding the notable silver premiums in Shanghai compared to New York, Farber highlights that these premiums have consistently been above 10% for most of 2024. Top traders on the Shanghai Futures Exchange have added back to their net gold and silver positions. Senior commodity strategist at TDS Ryan McKay notes. Based on his observation, Farber expresses that this sustained high demand from Shanghai indicates a significant change in the silver market. He believes Chinese buyers are engaging with silver differently, possibly due to a mix of factors, reflecting a sustained shift in the market dynamics for silver. Now we present the clips of Rafi Farber's insights from his recent video. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
This is a proxy for economic growth in the Chicago area in central North America, central United States, right? Central United States. We have here the Chicago PMI going back to 1968. And the red line is where I put the current read of, what is it, 35 or something like that, or something really. Anything below 50 is contraction. So two things you can notice about this chart is that we've been below 50 for the most amount of months in a row, excluding this 1 month. I think that was like a few months ago, maybe in April or May or something. But excluding this, I think we're 21 months in a row in contraction. That is the longest contraction ever in the history of this index. Here is the lockdowns. You had a reading of, what was it, 29? I can't really tell the numbers here, but the only times when we have lower than we are now, meaning more in contraction than we are now, was during the lockdowns when moving around was illegal and doing anything was illegal because we were saving the planet. And thank God it worked and there were no negative side effects to lockdowns and everything was perfect. Okay, we also have the 2008 great financial crisis, where we had lower reads than we have now for about 4 or 5 months in that period. And the time before that was 1981, 1982. And that double dip recession around when gold was at going to record highs and silver hit 50 for the first time. So this is a pretty extraordinary number. It means that the economy, the industrial economy, is really crashing in the central region of the United States, or Midwest is what they call it, whatever Chicago is technically called, who cares? And it's clear signs that the next and final official recession is gaining steam. It's been gaining steam for a while. When will it be in full bloom? I can't tell you that, but I can tell you the signs are all building up. It's going to be a big one, and it's going to lead to the last monetary printing round, I think, ever. Shanghai silver premiums. We'll talk about silver for a second. So I zoomed in here. For the first time, Gold Charts R Us is making it available so I can zoom in on 2024. I don't know why that hasn't been available until now, but now that I can see it, I can show you that we've been above the 10% premium line. The black line is what I drew in here. 10% premium Shanghai over New York. Pretty much the entire year, excluding like a few weeks, maybe 2 or 3 weeks. That looks like 2 weeks. Between March and April, we've been above 10%, and we've been above 8.5% basically the entire year. And if you zoom out, you can see that this has never really happened before. The only times we've been above 10% is very, very briefly for like a few days during these periods, and a slightly longer period, maybe a week or so, maybe 2 weeks in late 2014 as silver was finding its final lows. This is something else, though. This is sustained Chinese demand from Shanghai. Exactly what is fueling it, I can't tell you. I'm hoping it's silver stacking, but it's probably a combination of different things. Since these premiums are being sustained, it means that there is a sustained change in the silver market as Chinese people are relating to silver in a different way.
Regarding the recent zero hedge tweet, Rafi Farber discusses the yen's performance, noting it has recently dropped to new lows, making it the worst performing currency against the dollar in 2024, even worse than the Argentine peso and Turkish lira. The Japanese yen hit its lowest level since 1986 against the US dollar, trading at 160.39, driven by a significant interest rate gap between Japan and the US. Japan recently nudged its interest rates up to a modest 0 to 0.1%, but with US rates between 5.25% and 5.5%. Dollar assets are drawing in investors and pushing the yen down. Japan's Ministry of Finance and Bank of Japan have tried to intervene with $62 billion, but the yen's struggles persist. Farber clarifies that Japan's currency and bond market crises are occurring simultaneously. He predicts that even with the Bank of Japan's rate hikes, bond values and the yen's purchasing power will continue to fall. With the yen breaching key support levels, he foresees further decline. Let's get back to the interview.
I wanted to comment on this zero hedge tweet. Mostly, I agree with it, but there's one point that I want to correct here in the zero hedge tweet. So the yen, we're going to talk about the yen now. The yen, as we know, broke through 161 this morning. New low. We'll get into that in a second. So yen weaker than lira and peso in 2024. So this is the performance of different currencies, different international currencies versus the dollar. Year to date, 2024, the worst performing one is the yen. It is worse than the Argentine peso, which is a country in hyperinflation. It looks like Javier Milei might have mitigated that a bit with his libertarian policies. We'll see if it follows through. Still, the Turkish lira has been hanging around where it's been versus the dollar for 2024, but that country has been in a jogging hyperinflation for years, I think 2 or 3 years now, and the Japanese yen is doing worse than them. The tweet says, and the latter part of the tweet, the best part is once you finally contain it, it's talking about the Bank of Japan to the yen, once you finally contain the currency crisis in the yen, you have a bond market crash to look forward to. I slightly disagree with that assessment, and here's why. This is the next chart here. So it says yen weakness directly correlated with Japanese bond weakness. We can see here, and I've gone through this a few times, I just want to hammer home. It's so important, and so few people understand this, that the weaker the bond market is, the weaker the yen is. I've said it before, and I'll say it again. How this contradicts what Zero Hedge is saying in its tweet is once you contain the currency crisis, then you have a bond market crisis. But no, once you have a bond market crisis, you also have a currency crisis. They happen at the same time because the yen is the bond market, because the Bank of Japan owns so many bonds. That's what the yen is. So as the bond market unravels, so does the currency. There is no way to strengthen the yen at this point. If you hike rates, if the Bank of Japan hikes rates, let's say 4 or 5% to get rid of the spread between the dollar and the yen, then the yen collapses anyway because the bonds on its balance sheet collapse in value, and so does the purchasing power of the yen. Here is the chart of the yen, and I want to show you the technical situation we're in now. This is quite interesting. So I think the latest numbers on this is not 160.94. I think it's 161.1 or something like that. Whatever. We broke through 161. This is above the 1990 low here. Remember, the higher this is, the lower the yen is. This is the amount of yen it takes to buy a dollar. The final support here, that might not even be a support because it's so blippy. It's very, very tenuous over here, is 163.29 in October 1986. So 163.29, we had one blip, and then after that, we pretty much have no support until we hit this line over here, this dash line of 189.45. So the 163 I'm getting from this number over here, where I moused over it and I froze the screen. So we have 163 and then 189.45. There's basically nothing between 163.3 and 189.45. So once we break through 163, which could be in the next few days, it could be imminently, we could head towards 189.45. And none of this precludes that the Bank of Japan won't intervene here. They still have cash to intervene. The question isn't will they, the question is when they do, how long will it last? A few days, a few weeks, a month? Who knows? And what number are they waiting for? I have a hunch it might be 163.3 here, the final support zone, when they might smash it and then get the yen back into the 150s somewhere. And then we can, maybe a few weeks, maybe a month later, we can start heading towards 189.5. We'll see what happens.
At this point, it's worth noting that the market will more likely than not go looking to the $30, but it will be noisy on the way up. Given the current economic conditions and market sentiment, the outlook for silver remains cautiously bullish in the short term. The metal's ability to maintain quarterly gains despite recent weekly losses suggests underlying strength. What are your thoughts on these interconnected market movements, and how might they impact global economic stability? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.